welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Willem Oldewage from Nitrogen Fund Managers, Graeme Körner from Körner Perspective. Please be sure, send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X using hashtag Stockwatch. Gentlemen, appreciate the time today. Let's, Graeme, start with you. Let's jump into those momentum results that came out on Friday. I got to say, in an environment of low growth where it seems that insurers are more just stealing from each other than actually growing market share, the momentum numbers weren't bad. Your take, Graeme?
Yeah, I think, Simon, we've seen, I have a slightly different take. I think all the insurers are sort of pointing to a better environment, which is somewhat counterintuitive if you look at the pain that inflation and higher interest rates have caused. But generally, I think, doesn't matter whether you're talking Discovery, Old Mutual, Sunline, any of them, they're talking about, net inflows. So I think it's kind of the theme. Also, I think what has happened is, we were quite critical of the life officers for quite a long time, and we were more in favor of the new era guys, let's say the Signias and the modern, let's call them, service providers. I think all of these guys have got their head in the game, and they too are playing in that space. So I think for us, we're seeing, ironically, fairly good value in quite a few of the life insurers. We think Old Mutual, in fact, actually looks very well capitalized, and it's probably not an awfully technical term, but it's got a bit of mojo as well. So it has been a relative laggard for quite a while. So yeah, I think all of the life officers are actually talking about a better environment. And of course, asset markets are helping the insurance, the investment businesses and the underlying NAVs quite significantly.
Yeah, I take your point. Willem, your take on the momentums?
Yeah, I think they were pretty good. If you look sort of at embedded value and sort of return on embedded value, momentum, and as Graeme points out, most of the insurers, life insurers, trade at a discount to those values, where sort of the return on embedded value is at least above cash and sort of very close to their cost of capital, which means they should be trading closer to that value. So in terms of both, like exactly as Graeme mentioned, both in terms of the investment books and the sort of the underwritten sort of business, it's a fairly good result, and momentum specifically looked pretty good on Friday.
Then, and Willem, let's stay with you a sec. What about Santam? We've got a question coming through. We obviously saw the outsurance results recently. They were quite good. Your take on Santam as the sort of short-term insurers, which perhaps their benefit is their ability to reprice quickly as needed?
Yeah, correct. So Santam also looks good. We sort of oftentimes look at sort of relative valuations where Santam sort of lagged fairly largely over the last sort of 3 months, but did catch up. Post the momentum book build. I think there was a lot of movement there. In terms of the general business, same story, good return on embedded value, pretty solid discounts to embedded value, and also a very strong business with, like you say, sort of high potential to sort of exploit short-term price sort of differences.
Graeme, your take on Santam?
Yeah, I think it was good. I think one of the problems with short-term insurers, I believe that climate change is a very real phenomenon. And I think if you ask, who are the big beneficiaries of it, arguably there are a few clean energy plays, for example. But my personal view is that the short-term insurers are very vulnerable. You've seen, the claims coming through from, the floods and the hail damage. So I think extreme weather is going to become a big problem. And so I think the comparatives might have created a slightly misleading low base if you look at headline earnings, because they delivered, I think, about $16 versus, I think, 12 on the comparative. So that makes it look really, really good. But the underwriting margin, obviously up from that previous, let's call it, anomaly period where there was obviously quite significant claims in the previous year. And inflows or premiums were up, I think, about 7. That's probably largely in line with inflation. But, I have a real concern longer term about the short-term insurers. You saw Discovery, for example, going into Discovery Insure and, shutting some of those operations down and not really getting any traction. So, Simon, I think, the Santam results and outsurance, good results, but I have a really a long-term, let's call it structural concern for the industry.
Yeah, I mean, we've seen what's happening at the moment in Florida and Southeast USA with those insane floods going through. A question came, what happened to Hammerson? Up 900%, 10-for-1 consolidation. So you've got 10 times less the number of shares, but they're now all worth, well, in this case, 900% more. You should be net flat. Coming through around Kumba, and certainly a lot today talking around how it had, we've seen iron ore starting to move. Graeme, Kumba, the single commodity miners are always more difficult than the diversified, but of course if you get it right, and there's a lot of heavy lifting in that statement, can do spectacular well. Is Kumba one of them right now?
So it's a really difficult question to answer. I think, if I look at Kumba and I compare it, for example, with BHP's Western Australian operations, Kumba needs a much higher iron ore price just to sort of tread water. If memory serves, it's more than double the price. So, in a difficult sector, I would probably rather go for the coward's choice and go for the diversifieds with really top quality, low cost assets. So, right now, obviously, Kumba, like the other local miners, was very much a beneficiary of the China stimulus that lit a rocket under commodity prices generally, and that obviously having a leveraged effect through to the stocks. But I don't know. For me, it feels as though the iron ore price, the 150s, 160s were, a few years ago's thing, and guys are going to have to learn to live with, I think, higher costs of production, more difficult operating environments, and probably lower commodity prices than they've seen on average for the last 5 or 6 years. So that's the backdrop. As you say, if you get it right, you can make a lot of money, but it's a big if. And it's not just getting in, you've got to get out as well. So I'm not smart enough to play there. I'd probably rather just buy BHP and know that, the price can fall 50% and they're still making it.
Now, I take your point. Willem, Kumba?
Yeah, I think it is a function of the iron ore price, so specifically the rand iron ore price. So as Graeme points out, iron ore used to trade at sort of a 150 rand real in dollars for 2-3 years, but right now the rand's strengthened maybe 7-8% in a month's time, and iron ore is also up 7-8%. So Kumba's sort of rally isn't completely justified. I think if you believe the Chinese property stimulus will follow through, there's a lot of demand in terms of sort of rebar and sort of downstream products. Kumba's not expensive versus iron ore historically. So even though they're sort of less marginal than BHP at the moment, the spread at the moment is more something like $60 for BHP and an $80 for Kumba, which means at $110, which the futures are sort of pricing now, it's going to be much more profitable than BHP. The Kumba specifically also spending a lot of money on that UHDMS, the ultra high density media separation unit, which is going to sort of strip the dividends over the next year or two, which I think is a short-term negative for Kumba. It used to be quite an easy stock to price in terms of, sort of a dividend discount model. But given that, the combination of sort of the risk in the Chinese stimulus, whether it is enough, whether it's just sort of headlines combined with the fact that Kumba won't be benefiting from spot iron ore prices, at least for a year or two, makes it fairly risky. And I agree completely that something like a Rio or a BHP right now would make more sense.
I take your point, absolutely. And of course, I mean, not only even mentioned the challenges with Transnet, but those are real again. Rio and BHP don't have those challenges because they're in different markets. Willem, let's stay with you. A question that came through from the China statement last week, Tuesday, around stimulus. What's the best way to play that as a South African investor? I mean, certainly we've seen some of the PGMs moved. We've certainly seen Richmond. Or is it a case of, there isn't really much on our local exchange? I mean, of course, there's NASPA's process as well.
So it depends on how liberally you take sort of exposure to China. But if you do a sort of a sum of the parts of the JC, you can get to sort of 40 to 60% of JC revenues coming straight sort of from China exposure. Yeah. So that includes Richmond's China exposure, sort of NASPA's and process, all the sort of iron ore related exposure, lots of the gold, lots of the platinums, which means honestly, the JC is quite exposed to China, which is a big positive at the moment for us as sort of local investors. And then the big ones would be NASPA's and process. The only caveat is that we're sort of almost too late. I think the rally's almost already happened. The repricing in China was so quick, sort of 15 to 20% in a week's time, which means right now it might be better to sort of be patient and just see how the true stimulus phases out, because the rumor's been priced in and I think the fact hasn't really materialized. So the simple way would be NASPA's process, iron ore, and probably Richmond. But like I say, all of those stocks repriced almost on the day.
Yeah, and certainly we are surprisingly exposed to China already. Graeme, your take on how you're looking at the China story, and if there's anything on our local exchange.
Well, I suppose one of the easiest ways to play it, if you're betting on China, and I think one of the things that Xi Jinping is trying to do is trying to stimulate the consumer. Obviously, there are different angles to it, but through interest rates, through infrastructure, but also consumer-focused support or stimulus. If you believe in that, then I would say, rather than buying Kumba as a proxy for Chinese infrastructure spend or, consumer spending, you go to Richemont, for example, maybe you just go and buy yourself the Satrix China ETF.
Yeah.
Although, as Willem says, of course, the rand has been strong of late, but, as he says, the Chinese market has run quite hard, and we can debate in a second, whether it's ahead of the fundamentals or not. But although that market is up probably 15% in a month, the rand has also clawed back from where it was. So, the reality is in rand terms, maybe China's not as up as much as it would be on the index in renminbi. So I think if you like the story, you go and buy yourself the Satrix China ETF, and that will give you very good China, real China exposure, as opposed to buying a South African proxy for it. I think that I have some concerns about what is the real growth rate that sustains the Chinese economy, because we always think of a recession as being technically GDP contracting.
Yeah.
But in China, because the base is so high, I think the true stall speed of that economy is actually considerably higher. Maybe 5% or 4% is the level at which growth completely implodes. So I have some anxiety about whether the stimulus is really going to have the desired effect. But having said that, if you look at the Chinese market over the last 5 years, it's really taken quite a hammering. So there's probably quite a lot of optionality there, and we mustn't forget that although it's only growing at 4 or 5%, and we're debating now the merits of or how effective that stimulus will be, the truth of it is that economy is a gorilla, and it's structurally transforming itself. So it's gone from dirty, cheap manufacture. It's now very much into the consumer and into services, and increasingly moving into technology. So I would rather look at something like the Satrix China ETF if you're looking for pure China exposure.
Yeah, I like that. And there's also the Signia one, although I've always preferred the Satrix China ETF. Sasol. Willem, let's start with you. Sasol is a perennial one on this show because everyone likes it, but the price is going down. Your take on Sasol? I saw on Friday it was down sub 120s. I actually haven't peeked at it today. Willem, value in Sasol? Is this a bit of an overly brave man's game?
Yeah, I think it's a very brave man's game. If you sort of break down Sasol into its part, it's sort of chemicals and then sort of the oil price and sort of cracking spreads for petrol and diesel. And somehow, even when oil prices were strong, Sasol couldn't really benefit. So I think the market's seeing oil prices down 10% in the month, along with a very strong rand, and it's becoming sort of worrying, like how Sasol's results will look, because they cancelled the dividend, they're struggling to raise debt, and the company isn't performing. And then long-term structurally, Sasol is very, very poorly positioned in terms of an ESG perspective, which means they're spending all their capital at the moment on sort of ESG projects, which have no shareholder return, which is concerning as a shareholder, but also concerning sort of for other stakeholders, for employees of Sasol, for customers of Sasol in terms of sort of gas. So at the moment, I think Sasol is a very sort of troubled company, where in the past you could always sort of buy Sasol on the dip, and you could always sort of reference it to the oil price. At the moment, it's not like that, and I think that's not something I would expose myself to at all. I think as an oil investor, there are much better options, sort of Royal Dutch Shell, or even Total. There's lots of listed options globally, and there's no reason to invest in a company that's exposed to oil but not driven by shareholder returns for the moment.
Yeah, Graeme, Sasol, it is a bit of a horror story.
Yeah, it is. I mean, if you just look at the consensus forecasts, I'm busy looking at them now. So to June of 25, the market is looking for just under 44 rands worth of earnings. At 115 bucks, you say, well, that's on the PE is less than the fingers on my hand. That's ridiculous. But I think, as Willem has rightly said, it's not a pure rand oil price play. Of course, polymer prices have also been weak. You've seen the impact on something like cup, for example. So I think the problem is that it's not the same old Sasol that we knew. I think arguably they're now being, current shareholders are being forced to pay the price of poor decisions that were taken, probably quite a lot of them, everything from hedging policies and when they needed it most through, we all know the Lake Charles story that's been well publicized. But for me, it's no longer a simple South African energy play, or even if you want to take the Qatari operations, it's become messy, and unfortunately, they have to pay a price in inverted commas for CO2, and I think that's the thing that's worrying the market. It's a wild card. So on fundamentals, it looks really cheap. I sort of feel that fair value is probably about 250. It's more than double here, but I'm not going to buy it. I'm simply saying if you hold it, it really looks cheap. Hopefully, they can navigate these conditions, and whether it's oil prices or the chemical prices, if that cluster can go higher and they can maybe deliver even, maybe slightly below what consensus is and start paying a dividend again, then, you may get some sort of market-related multiple in due course. But it's, I don't want to call it trouble, but it's not far from trouble.
Yeah, and it certainly has been having a tough time. Graeme, let's stay with you. York Timber coming out with an update earlier today. Trading discount to net asset value, that's not unusual for that company. They typically have for quite some time. Swinging, looks like, back into profits. Your take on York? The question was, surely it's a screaming buy at such a big discount to NAV. I've been caught with that trick before on value traps.
Yeah, value traps can hurt. I think York is, I do believe that long term, if you said, right, York doesn't plant another tree and all they do over the next 15 years is harvest what they have, then you could actually argue that discount to NAV story is actually quite real, So I think it's a business that's in transition. You'll remember a couple of years ago, they did a rights issue because they said operationally they were having to buy timber in from Safcol principally, and they were paying a lot for that and unable to sort of sustain the margins. And they were extending their growing cycle from 20 years or harvesting cycle from 20 years to 22 years because of the impact that had on the bulk. So, we're probably about halfway through that transition. The results today, if you exclude the biologicals, it didn't look great, but you would expect that for the business, and that's exactly why they did the rights issue, was really just to give them the cash to see this season through. I do believe that it's very, very cheap, not from an NAV point of view, but I think I can see a scenario where, again, we talk the climate change thing. People who've got, trees in the ground that are 5, 10, 15 years old have an advantage. And I do think that timber prices are going to go up for, people who are actually buying the end product, and that York will ultimately be a beneficiary of that. So I'm not saying, NAV is the target, but I do believe that I can make an investment case where, the fair value of this thing is actually considerably higher than the NAV a few years from now, if you model price increases and enhanced yield through the lengthening of it. So, today's results, excluding biologicals, look sickly. Then you bring the biologicals through, which I believe is probably sensible, and it looks better. But at an operating level and at a cash generation level from ops, it didn't look good. But it for patient investors who are not afraid of shares that trade by appointment, I think it's a very worthwhile punt.
Willem, your take on York? I mean, it is a proper small little cap that people get, every so often it gets a flurry of attention and then it seems to get ignored forever in a day.
Yeah, I have to agree. I think it's sort of long-term fundamentally, there's nothing wrong with York Timbers. I think in the moment they're in the middle of a turnaround strategy and they're a very low liquidity stock. So until they can convince sort of a larger investor to sort of buy up that overhang of the low liquidity, it's a good long-term hold. I think you'd match market returns over 5 to 10 years. So I don't think there's anything wrong with it, but I have to agree that it's not necessarily a buy at spot, just based on the liquidity and sort of the short-term operational results will drive the short-term pricing as it always does.
Willem, let's stay with you. Question coming through around Cashbuild with the better-looking South African consumer, two-pot interest rates, inflation, etc. Opportunity for Cashbuild?
Yeah, so that sort of industry has been very well performing over the last few years. I think they had a very strong push in COVID, and it's sort of come off a bit. I think overall, to be honest, in terms of sort of South African expenditure on housing and sort of DIY projects, they are well exposed. And I think the two-pot system with the GNU and sort of inflation expectations, there's a lot of positivity in South Africa. Just things like a strong rand and a low oil price means low petrol prices, which all of that drives sort of consumption and sort of building and construction. In terms of sort of entry points, that's the same as it always is. It's also not the highest liquidity stock, but again, in terms of fundamental business case with sort of moats and exposure, there's nothing wrong with Cashbuild. I think it is a good entry into a decent sort of South African-based business segment.
Graeme, Cashbuild?
You know, Simon, there was a time where we spoke about Cashbuild as the team that walked on water. They going back more than 5 years, but if you look at the share price, it's down on where it was 10 years ago, which tells you it's a horrible business and it's broken, which I don't think is right. But, they've had the perfect storm against them. Supposedly, I mentioned it earlier in terms of inflation, the lack of real inflation protection for the average household, plus interest rates. It really hasn't been a happy environment. But I think it's a good business. It's well run. Obviously, a couple of I think the competitive environment has become a little bit more competitive for them over the last few years. Probably a little bit of, becoming a victim of their own success. But I think it's a good business that I think exactly what Willem was saying. Suddenly you get a little bit more confidence, inflation easing, interest rates coming off. It's the kind of business that really could take off just because the fundamentals are actually quite solid in the business, and I think the outlook is improving. So yeah, I think it's looking quite cheap at the moment.
Willem, let's touch on PGM stocks. A particular question coming through about Implat seems to be lagging. And is PGMs a case of let's rather wait until we see something happen in the metal prices, or is there opportunity in the space?
So we spoke about this last week, and I think I sort of very confidently said that I thought it was overdone. And I think if you look at the European car sales, Stellantis today, and then I saw even Aston Martin, it looks terrible. Their margins are being compressed, and yes, there's a case to be made for sort of EVs overtaking the overtaking of EVs slowing down, and then sort of ICE engines coming back on board. But I think there was a lot of exuberance in this recent rally, partly driven by Sibanye's sort of cuttage of about 100,000 ounces of palladium in their results. But overall, the range for platinum prices and palladium prices, the whole basket is set, and at the moment, it's very marginal. Implats, for my eye, looks like it overshot rather than lagged. I think it's up 30% for the month. AMS and Northam are up 5 to 10, and for the year, it's the same story. It's about 30 to 40% ahead. So personally, I would not want to be exposed to Implats right now. I wouldn't say short it. That's too brave. But I think it looks like today PGM prices are coming down more specifically on the Eurocard news, and I think the stock's overpriced or completely priced in any sort of positivity, and some of the downsides, some sort of coming back in the underlying metal markets.
Okay, and Graeme, we haven't got your time. We need to go to stock picks. You're going with Aspen.
Yeah, Stephen, it's a company that the market loves and then hates, and if the market expects something and they don't quite deliver it, then you get a little bit of a tantrum, and I think that's what happened. The stock was over $250. They came out with results that, if you actually unpacked it, I didn't think were that bad. Obviously, you had the heparin model change that sort of also skewed things, which I think is part of the problem. When you're operating in 100 countries, you've got manufacturing operations all over, with different input prices from different currencies, and a fairly complex model, and the products you produce are complex, and the competitive landscape is very complex. The market, I think, battles with this one. When I listened to the results presentation, it was like a few years ago, the message that was coming out from management was one of, we've settled down, the business model has grown up, there's a lot of optionality, there's lots of capex that has been spent that hasn't generated an income. We've got spare capacity in Quebec on those lines, and that will generate a return. The margin's going to improve. It was really a positive message, if you just for the share price coming down. So, I think if I look a year out and I say, well, to June 25, earnings forecast, I think is about $18.
Wow.
I can see 15-20% upside from here. And if I fast track then to June 26, and I believe the forecast, which I do, then there's considerably more upside. So I think it's business that's actually looking a lot better. To me, it really has grown up, and I get the sense that the downside is actually quite limited, particularly if those margins improve, because it's a relatively predictable model in a lot of the products. So yeah, I'm going to go with Aspen. I think in the mid 190s, it's looking really cheap.
Aspen looking good there. Willem, Afrimat.
Simon, you asked us earlier sort of what can we buy to get exposed to China. So I've been spending my morning sort of looking for something that hasn't reacted yet. And I sort of came across Afrimat. So apart from the fact that they have bought an iron ore mine about 2-3 years ago that will do well in sort of any sort of Chinese exposure, specifically to iron ore, they've got a strong management team, and specifically in terms of their cost and their metallurgy, they've got real moats, which means sort of their basic sort of business without the sort of expansion has done very well. And then looking around the JC, they're probably one of the best allocators. I think if you have a look at the combined sort of earnings growth due to acquisitions and without, they're one of the only ones where there's a marketable positive influence in terms of acquisitions. So they're prudish, they're focused on free cash flows, they have some moats in the business. And then as of this morning, last week, they are exposed to the Chinese sort of industrial metal sector, which sort of did really well for them the first year they bought it, when the rest of the economy was doing poorly and iron ore was floating $150. So that kicker stays there. And I think overall, good management team, decent valuation, sort of a simple long-term buy at current valuations.
Yeah, and of course, Lafarge South Africa, if anyone can turn that around, it's Andries van Heerden and his team. That's all for tonight's Stockwatch. Thanks to our guests, Willem Oldewage from Nitrogen Fund Managers, Graeme Körner from Körner Perspective. Up next, The Close. Stay tuned.